Once you've established a habit of regular savings, you've learned to live on less than you earn, and you've accumulated a cash reserve equal to 3 to 6 months worth of your living expenses, you're ready to begin making your savings work for you. You're ready to make investments that will make your money work as hard for you as you did to earn it in the first place. Now, the word investments can conjure up all sorts of images depending on our experience and frames of reference. How much to invest in which kind of investment and why can be a challenging line of thought. Here's a concept that may help you organize your thoughts about how to approach structuring your investments. Visualize a pyramid. Architecturally, this is one of the strongest structures that's ever been built and provides a helpful metaphor on how we should structure our investments. At the very base of the pyramid, we would put our most secure, safest investments that will preserve our hard-earned savings. The first layer of the pyramid's foundation is the 3 to 6 months of cash reserves we accumulated to protect us from having to worry so much about the little emergencies life seems to hand us from time to time. Next, we would layer in any cash we might be holding for near-term planned expenditures, such as buying a new car, adding a room onto our home, or taking a special vacation, so on. The next layer, moving up the pyramid, would be also fairly safe and secure sorts of investments, things such as certificates of deposit, U.S. Treasury bills, notes or bonds, corporate bonds, municipal bonds, fixed-rate annuities, and then perhaps bonds of other kinds, such as government bonds issued by foreign governments outside the United States. Following these relatively safe and secure income-oriented investments, and further up the pyramid, we might consider investments in the stocks of big, well-established, financially strong companies. Certain kinds of real estate investments might fit in this layer as well. Mutual funds and exchange-traded funds of these kinds of securities could also fit in this category. Next, we might consider stocks in smaller, emerging growth-type companies that are still expanding and growing at a faster pace than the old, well-established companies might be able to do. Again, mutual funds and exchange-traded funds that own stocks of these small, growing companies would also fit in this category. As we approach the top of the pyramid, we might consider more exotic, more higher-risk investments that offer an even greater potential return on our money. Notice that as we move up the pyramid, we're taking progressively higher investment risks, but doing that with progressively smaller amounts of our money. That way, if something doesn't turn out as well as expected with one of our higher-risk investments, we'll still be okay. A well-balanced investment plan might include all of the elements we mentioned here. However, the proportionate share of our money committed to any particular investment should be small. This practice will limit any chances that the consequences of any investment's failure to perform as expected will knock our overall investment plan off track. So when you consider different possible ways to invest your savings, remember the investment pyramid. Start with a strong foundation of adequate cash reserves. Build on that foundation with more conservative investments in the beginning, and then gradually expand to increasing levels of investment risk that provide a chance for much higher return. If you keep the investment pyramid in mind, you'll have a handy guide to helping you choose investments wisely. Join us again soon, and we'll have more for you in another installment of The Financial Briefing.